On June 11th, Chinese internet company NetEase carried out a secondary listing in Hong Kong, leading the homecoming listing trend of US-listed Chinese companies this year. A week later, another US-listed Chinese e-commerce giant, JD.com, also had a dual listing in Hong Kong, marking this year's largest public offering in China with about $3.9 billion raised. So why do companies seek a secondary listing? A secondary listing refers to a listing of any security on two or more different exchanges. A secondary listing usually attempts to access additional liquidity, new markets to raise capital, and the ability of shares to trade for longer periods if the exchanges on which shares are listed are in different time zones.
It is more secure for them to have listed company identities in other capital markets, like we say eggs cannot be in the same basket.
Although most of the new economy companies do not have a high debt ratio, they still require new funds to invest into their new business or do more R&D projects. Apart from fundraising, the companies can also capture a higher valuation in long term.
US-listed Chinese companies carrying out secondary listings in Hong Kong is not new. Last year, Alibaba Group pioneered the practice of secondary listing under the new regime of the Hong Kong Stock Exchange. Why did they all choose Hong Kong?
The reform of secondary listing in 2018, along with the weighted voting rights regime, were aimed to attract China's high-growth technology companies to come back to list in Hong Kong. Also, there was a reason about the geographical and cultural proximity. Hong Kong had traditionally been seen as the venue of choice for China-based companies because it's more cost-efficient and culturally compatible to these companies. In addition, Alibaba's return to Hong Kong last year really cast a vote of confidence to Hong Kong as one of the paramount international financial centers, and it proved Hong Kong's secondary listing reform a success. Lastly, as compared with the other options, like London or continental Europe, Hong Kong market has a deeper and a more diverse pool of investing capital, more liquidity, as well as a better understanding and therefore higher valuation of Chinese companies.
The leading position as a global international financial center of Hong Kong doesn't have any obvious change. It still remains its core competitive advantages. For example, the free flow of capital, the high stability of the peg rate system, and a reliable regulatory system. The recent situation in Hong Kong will only have a limited negative impact on the homecoming companies or the returning trend. I believe that the trend will last for 1 to 2 years.
The recent high-profile home returning cases are just the beginning of the story. As of June 2020, about 42 Chinese firms, which are now listed in the US, are eligible for a secondary listing in Hong Kong. This accounts for approximately 46% of the total capitalization of US-traded Chinese firms.
Hong Kong Exchanges and Clearing Limited CEO Charles Lee said that it is going to be a big year for IPOs, including both huge IPOs from the Chinese mainland and very substantial returnees from the United States. What factors are driving the homecoming listing trend?
I think it is affected by the global politics and the economy environment. As we know, there are lots of uncertainties between China and the US in the aspects of politics, economy, and of course the capital markets recent years. Therefore, it is safer for the US listed companies to get listed in Hong Kong market, minimizing the instability and the risks for them.
Apart from the tightening regulation in the US, which is just one of the immediate triggers, there is the whole other series of factors at a more intrinsic level. These factors mainly include proximity of business market and customer base, better cultural recognition, wider spread of shareholder base, as well as the rapidly enhancing synergy as a result of the increasingly integrated stock markets in the Greater China region.
The multi-million-dollar accounting fraud of China's coffee brand Luckin Coffee, to some extent, triggered a crisis of trust in Chinese firms listed in the United States. After that, the U.S. SEC chairman publicly warned of the risks involved in the U.S.-listed Chinese companies, which is rare. Have the Chinese companies lost trust in the U.S.?
It has no doubt that the case would significantly hinder or hurt the U.S. investors' confidence on the listing Chinese firms. The venture capitals or the private equity companies will be more cautious and probably set a higher hurdle rate when investing on those immature or fast-growing private Chinese companies.
Luckin Coffee is an individual and isolated case. I don't think we should treat Luckin Coffee as a common feature of all PLC companies. To a certain extent, the case is a bit overstated, and to be honest, the Luckin Coffee issue, if any, is not unique to the listed companies in all advanced and mature capital markets. The key issue is the quality and integrity of listed companies. One point, which is interesting and worth consider, is that the US stock market is mature, and the key players are professional and sophisticated investors. The professional investment houses will do in-depth analysis before making the investment decision. To state the obvious, the macro picture is that the global investors are still recognizing Chinese firms for their strong fundamentals and business prospects. Investors are more than likely to stick with the case-by-case mindset when considering the value of Chinese firms.
We've also seen many mitigating actions as well as positive signs ever since. China's securities regulator publicly and solemnly criticized Luckin Coffee for its fraudulent disclosure and pledged to push forward the cross-border enforcement cooperation among securities regulators as appropriate and necessary. Meanwhile, US investors' confidence in Chinese companies seems unaffected, as there are very successful US listings by Chinese companies recently. For example, Kingsoft Cloud, Burning Rock Biotech, Zhenchong Health.
In May, the U.S. Senate passed a bill that would require overseas firms to follow U.S. standards for audits and other financial regulations. Some presume that the move targets Chinese firms. If it becomes law, how will it impact U.S.-listed Chinese companies?
Apparently, this will be highly problematic and unrealistic for Chinese companies. If implemented, U.S.-listed Chinese firms will face a dilemma between complying with domestic laws and opening their books to the Public Company Accounting Oversight Board. The new regulations definitely create additional compliance burden and pressure to US-listed Chinese companies.
It is still not clear whether it will become a law or not. If yes, the impact is huge to US-listed Chinese companies. They probably have to delist in 3 years unless there are exemptions agreed with the US and China government.
If the bill is signed into law, it could threaten the listings of nearly 250 Chinese mainland and Hong Kong-based companies whose shares are traded in the US and whose auditors are under China's jurisdiction. What's the impact on the US market if a large-scale delisting of Chinese firms happens?
First of all, extensive delisting would cause listed companies from all other countries to double-check and rethink the idea of listing in the US, including the high-quality companies which the US would not want to lose. Secondly, many Chinese companies listed in the US market are actually leading private sector players from across many sectors in China and even globally. The US investors have benefits both from the share price appreciation and profit sharing in the past. Delisting them would risk throwing away the baby together with the bathwater for the US investors. In the medium term, the US financial services industry would also get hurt severely at the end of the day. Loss of business.
China is the second largest economy in the world. If US market has lost Chinese listed companies, it is no doubt that delisting will harm the integrity of its capital market and its valuation system.